Good morning, Valerie.
Good morning, Anne.
I'd like to introduce Valerie Bruneau. She began her career in the field of insolvency with Ginsberg Gingras in 2007. She received her CPA and CGA in 2014, and she became a licensed insolvency trustee in 2015. She's been entrusted with many business insolvency mandates before being put in charge of the personal insolvency operations for the Greater Ottawa region for Ginsberg Gingras. Welcome, Valerie. So you've heard the conversation I just had with Gord. And so just to follow in that vein, I guess one of the first questions I have for you is, what are the signs or triggers that someone should look for to seek out your services and come see you? Is there something, that twigs or you think is a good time to come talk, or what would you suggest?
Well, what we typically see, Anne, is there's an event or there's something that will happen, such as a loss of major clients, a drop in business volume, maybe increase in production costs. So those, maybe that event or a pandemic, maybe that event will then trigger some cash flow problems, for instance. And how these translate in the day-to-day, well, first off, maybe the business needs constantly to use some credit, either a line of credit or a loan, to pay current expenses. Maybe those current payables that usually you're able to turn over on 30 days, maybe they're going in the 60 or the 90 days column. Perhaps you're starting to get some of the collection calls from the suppliers. Maybe they're starting to be unhappy. And at one point, maybe they'll tell you, you know what, unless you pay your bill in full, we're going to stop to supply. Maybe some checks are starting to bounce from the account. And we often see that delays are going to start on GST remittance and source deduction remittance as well. And maybe last thing to watch, and as a sign, is maybe you'll decide to stop to pay yourself a salary as the administrator or the director. So those are signs. Maybe they won't happen, all of them at the same time, but you need to watch for those specific signs. But I think it's really hard to see them. And I think Gordon explained out of his own experience. There's a lot of pride. And it's hard also because there's no distance for the director. So it's unless somebody external, like the accountant, maybe he's going to be the one who's going to raise some issues. And I also think it's not always easy to see the signs, because we'll build on fear of consequences for maybe our staff losing some job, maybe some of our suppliers that we've dealt with for a number of years that we're not able to make payments to. So even if there are some signs that we can see, I think it's not always easy to see them for those reasons.
So once they've kind of looked at it and they've come to you, and they said, okay, so they're still operating. They're just having a bit of cash flow challenges, which you've indicated. When they come see you, basically, what are their options? Can you kind of explain, like Gord alluded to the NOI, but what really are the options that someone has when they come see you?
Definitely.
What can you do for them?
So what Gordon was talking about, the NOI, so notice of intent, that would be a preliminary filing that would result in a proposal. So it's basically a legal proceeding under the Bankruptcy and Insolvency Act. And you can either go through that process or go through directly the Division 1 proposal, which is an arrangement with the creditors, which is ultimately a plan to restructure. So the NOI, the notice of intention, is going to give you a bit more time to work on the numbers, work on a projected cash flow. So that is one option that's offered under the Bankruptcy and Insolvency Act. Another option is to use, and that's what we typically see like in all the big business, retail and larger corporations in the media, when we hear that they seek creditor protection, that would be under the CCAA, which is the Companies Creditor Arrangements Act. So it's kind of a sister act to the Bankruptcy and Insolvency Act. It's for larger corporations, and in order to be eligible, you need to owe more than $5 million. So if you fall into those criterias, the process under the CCAA will then involve the courts. The ultimate goal is to negotiate a plan of arrangement. And because it's more of a tailored process, well, then we can see that it's a bit more costly with involving a monitor, involving a lawyer. So it's more for larger corporations. So the CCAA, one option. Then under the Bankruptcy and Insolvency Act, you have the notice of intention and then Division 1 proposal, which allows the same option to negotiate a proposal with creditors. And when we talk about creditors, we talk about the government. So we talk about unpaid GST, we talk about the loan with the bank, suppliers. So those are all creditors that under a same proposal were able to come in and negotiate term of payment. So typically what we will see is a term of payment under a proposal that would be stretched out on 5 years. So it allows to rebuild the business and then have a projected cash flow on the next year and work from that cash flow and then be able to repay the creditors. So the repayment plan, good thing about the proposal is it stops interest. So when the proposal is filed, we work towards a goal and repaying. Usually it's a percentage of what is owed, like Gordon said. The percentage will vary from a file to another. It depends on the cash flow. It depends on the assets that the business has. It depends on a number of things. But in the proposal, ultimately, you need to expect that you'll have a term of payment. It's based on the ability to pay, so based on the cash flow. And ultimately, it's going to reduce the total that you need to repay. So that's what the Division 1 proposal is. And then if after coming in to see the trustee, you're just saying that maybe the business is not viable anymore. Maybe the model is not viable. There's no way to revamp it. Well, then in that scenario, you would opt for a bankruptcy where the trustee would come in and liquidate the assets, and the funds that we would recuperate from the assets, we would use that to repay the creditors, and give them back some cents on the dollar. So the restructuring options do exist. And they allow to continue doing business. But if the business is not viable anymore, that's when the bankruptcy option would come in.
So in the two options that you've talked about, and you alluded to it with employees, is there any difference? Like if it's a small business, owners are always, very invested in their employees. There's a family feel to it. How are the employees treated in one case or the other? Is there any difference on the employee side under the two approaches?
So in the bankruptcy scenario, there's a federal program that I will compare to EI. So Service Canada has a program which is called the Wage Earner Protection Plan. So when an employer files for bankruptcy, the government will come in and make a payment for the unpaid. It includes unpaid wages, unpaid vacation pay, and also the unpaid severance at the end of the process. So even though as a small business you file for bankruptcy, the government will help out and will step in if there's not enough assets to cover the unpaid employees. So that's something maybe that can alleviate some of the stress that and in the decision making that you can have towards unpaid employees. Whereas if you look at the proposal, then you would basically, the company, it continues as a going concern. So it needs to continue to pay its employees as it would normally do. So if there's an unpaid amount, then it needs to be settled in the proposal, in the plan itself.
Perfect. So with what you've talked, you've alluded to things. Someone comes to see you and they want to work with you. What professionals would you suggest they get involved, or what should a client do as they're evaluating their options or trying to determine what's the best way forward? What suggestions would you give them?
So I think working with a good accountant is a good first step, because the accountant is going to be able to review the financial aspect of it. So it's somebody that is going to be impartial and maybe bring that distance that maybe the director is not able to have when reviewing the numbers. And then a lawyer is also a professional that can help, because at the end of it, the director also needs to know personally, does he have any risk? And he needs to manage that and to know what effect his decisions on the corporate side, what effect it can have on his personal side. So the lawyer is also part of the team, definitely.
So with it, and you're going through the process, and there is a little bit of a stigma attached. Some people, because there's the pride, they built the company or what it is. If you were talking to a business owner and trying to explain to them why this is a good solution or something that they should consider, is there a way you would explain it to them that, it's not their fault, or this is what it is? Or how do you deal with the emotionalist side of a business owner coming in the position that they are? Is there anything, questions that you would have or comments for the client that you would have in regards to that?
Well, I think you raised a good point. There's circumstances that happen that are out of your control. So even as the business owner, if you have some pride, I think you need to recognize at one point in time what you can and what you cannot control. And I think once you've accepted the fact that some things you cannot control, but you can take control now and look at the future and make some changes toward the future. And maybe filing a proposal or notice of intention is taking a step back in a way for the short term, but looking at the long term, it's allowing the business to restructure and to, like we've seen in Gordon's case, the business is going better now than it was previously. So it's just not seeing just one tree, but seeing the forest, and having a look at the big picture and seeing it in the long run. And sometimes we see business owners that They're starting to have some effects on their health. They're starting to see effects on their family, their marriage. So at one point in time, it's also a question of maybe thinking about what your priorities are and thinking about yourself. Because I think in life, if you don't look at yourself and don't think about yourself, nobody is going to, right? So I think is setting those priorities to address.
So, and I just want to note, so if someone comes to see you and they have questions, it's just information gathering. If they come to a consultation, it's just kind of finding out what it is, find their option. Is there a charge if they come see you?
No, there's no charge. And I think just having a good conversation, it's not easy, but at least you'll have the opinion from the professional directly. So it can take maybe an hour to go through the situation and explain what options. And we've talked about bankruptcy proposal, CCAA today. But there's a lot of gray area where at the consultation we can give the proper information tailored on a specific situation. So I think it's never too early to come in and see the trustee just to inquire and just to see what is my worst case scenario. So what will happen if I'm not able to secure money from a lender or find a new investor? So what is my ultimate worst case scenario?
Okay, that's great. Valerie, there's a question here for you, and it goes, Valerie, it sounds like your job's a mix of financial solution provider and a social worker. Would you say that you need to understand the client as much as you need to understand their finances when you meet with them? Well,
it's a good point. I think as a trustee, we wear a couple of hats, definitely. It's important to have the big picture and to take everything into consideration. It's really a human job where you meet with it's a business owner, it's a father, it's a mother. So ultimately, you need to take the time and listen to their situation, their story, and then it's a question of finding a solution. So definitely, I do agree with that. It's a mix, and we need to take the time and do it. Yeah, definitely.
All right. So as you're doing the understanding, you're working with them. If they choose to do the intent to restructure route, how long does that normally take?
Well, there's some deadlines that are set out in the process itself. So maybe a bit of theory. So when you file the notice of intention, you then have 30 days to come in and have a formal plan of action, which is the proposal. You can go with the courts to have a bit more time if it's needed. And once the proposal or the plan is submitted to the creditors, then they have 3 weeks to vote. So the trustee is going to collect some votes from each creditor, and we call a meeting. And the purpose of the meeting is to talk about the restructuring. So talk about that proposal, and maybe we're ready to take the decision now, or maybe we need to postpone. So typically, I think within 60 or 90 days of the filing of the notice of intention, you'll know the outcome. So you'll know what the plan is, what the proposal is, and then you know what the term of payment is. And like I said previously, the typical term of payment would be on 5 years.
So following up on the notice of assessment, there's 2 follow-up questions. One is, A, do all creditors receive the same percentage?
So all the creditors would be into one category, and then there would be a term of payment for that specific category. There are some exceptions, such as unpaid source deductions. So when you come in the notice of intention process, if you're late with your source deduction remittances, those need to be paid in full. So they would not be rebated like the other creditors. So let's say you're able to come in with a proposal that repays 40% of the GST, the suppliers, well, the source deductions would be something apart, and it would be 100%.
Okay. And another question, follow up on that. So how does the NOI impact the existing investors and a board of directors? Is there any concern for them with regards to the whole process or anything, or any risks to them?
Well, ultimately, if the plan is approved and if the plan is respected to the end, the goal is to come in with protections for the directors. I'll give you an example. Unpaid GST, as a director, you have a personal liability. So if your corporation owes $50,000 of unpaid GST to the CRA, well, as a director, you're personally liable for that. So in the plan, if we come in and negotiate the unpaid GST, then the goal would be that the director is not personally at risk. So that's also an advantage with the proposal, is ultimately when it's said and done, well, the director is basically off the hook, and everything is paid and accounted for.
Thank you very much, both Valérie and Gordon.